In this video, I am going to tell you how to use debt to make passive income. It might sound like a scam. How can debt ever be good? I mean, when you hear the word debt, what do you think of? Probably something negative like your student debt. How much did you borrow to go to college? $20,000, $50,000, or perhaps $100,000 if you went to Ivy League. It's frustrating to see that number growing while you're barely making enough money to pay your bills. Before the bank handed you $100,000 to go to college, everyone told you these stories that if you go to college and get good grades, you will get a job that will pay for everything. But here you are, made it to the end, and you barely found this job. And now some random guy on the internet is about to tell you how to make money with debt. As fake as it might sound, debt is what keeps the world running. It's not cash, it's not the politician, it's not Wall Street. Everything is run by debt. Whoever knows how to use that debt wisely isn't just making a lot of money, but running the world. These people who are using debt aren't just making like 500 grand a year, they are making like billions of dollars. But what we want to focus on is how you can make money with debt, how you can use it to create passive income, how you can turn your debt into an asset that will forever keep generating income. If you're ready, give this video a thumbs up and let's dive in. Here is a simple question. Why would anyone give you millions of dollars when they can use that money for themselves? Why are they wasting it on you? Let me tell you a secret. You have no idea how much money there is in the world. Trust me, the amount of wealth that is there in the world is unimaginable. There are people who have hundreds of billions of dollars in offshore accounts. Officially, there are around 1,000 people with a net worth of at least $1 billion in the United States and 3,311 billionaires worldwide. And this is just the official number. If you have a private business, nobody knows your numbers and nobody can have access to your financial statements. You could be making hundreds of millions of dollars a year and nobody knows. So you could be one of these undercover billionaires. Now every single day this enormous wealth is stored in offshore accounts and inflation is eating it up. Apple alone has over $200 billion of cash stored in offshore accounts. So if you can come up with a way and say that you will borrow this money, use it effectively, that you can give them back at 2 or 3% above the inflation rate, they will gladly lend you that money. It's as simple as that. Now, inflation is like 7 or 8 or 9% now, but normally it's about 2 to 3%. So any money you make above 5% is yours. Let me tell you how rich people use debt to make a ton of money. What business do you think when you think of Starbucks? Selling coffees, right? That's what they want you to think. Starbucks is the place you go to get your daily latte. But what if I told you that Starbucks is actually a bank? It's a bank like JP Morgan, Wells Fargo, Citibank, you name it. If you're a loyal Starbucks customer, you probably have the Starbucks app downloaded on your phone. And whenever you pay for your daily caramel latte, you use the app to pay for it because it lets you generate points that you could eventually use to get a free coffee. As much as they want you to believe, making a cup of coffee is cheap. Starbucks is charging you like $6 or $7 per venti frappuccino, but the actual cost is literally pennies. So for them to give you a free coffee once a month because you buy a coffee from them every single day is nothing. But most importantly, you hold your money in their wallet so that you can earn these points. At the end of 2021, users held a collective of $1.5 billion in balances. $1.5 billion might not sound like a huge amount of money, but it's more than what the most banks hold in the US. Starbucks can do whatever they want with that money. open more stores, invested in real estate, expand their operations across the globe, invested in the S&P 500, trade stocks, whatever they want. They know that you're not going to ask for that money back anyway. In fact, when it's about to be over, you are going to reload your Starbucks wallet for a week or a month. Starbucks built a business that essentially relies on borrowing money from customers with zero interest in return for giving them a cup of free coffee a month. Isn't that genius? Starbucks isn't a coffee company. It's a bank that sells coffee. It can simply lend that money on interest to someone else and live off the interest it will generate out of it, since it pays zero interest to the people who lend the money to Starbucks in the first place, except for a free cup of coffee once a month. That's not the only way the rich people make money with debt. Banks are ripping off the little guys, like you and I. It's us who pay for decades of interest on the student loan we borrow to pay the bills. But the rich only benefit from the banks. Banks are like passive income sources for the top 1%. Imagine you're a wealthy dude. Elon Musk, Mark Zuckerberg, doesn't matter. You have this tech company that is worth like hundreds of billions of dollars. You might own like 10 or 20% of the company. On paper, you are a billionaire. But if you turn around and sell those shares, you will cripple your net worth. It will just crush the stock price, making you poorer, so you cannot do that. So how about using the profits your company generates? Nope, you can't do that either. Your company might earn like billions of dollars, but it has to reinvest that money back into the company. Otherwise, there is like a 30% corporate tax waiting for you. So what do you do as a tech CEO who owns stocks worth billions of dollars? You go to a bank and ask for $50 million. But instead, the bank will give you $100 million to buy a private jet, a yacht, or a couple of supercars. What are you going to do in return is give your shares to the bank as a collateral. The shares are still yours. The bank can only sell them to get back their money if you won't be able to pay back your debt. So you're fine as long as you make your annual minimum interest payment. The interest on your loan is going to be very small because you are considered to be a high net worth individual, and the chances that you will go broke are very slim. That's why billionaires, even though they have like so much money, they still borrow money to buy their expensive toys. Mark Zuckerberg took a mortgage to buy his Palo Alto home. Elon Musk borrowed money to buy his luxurious mansions in Bay Area. As the price of your shares keeps rising, you keep borrowing more and more, financing your lavish lifestyle while making the minimum interest payment to the bank. And when you finally make a profit, oops, your tax rate is going to be significantly lower because you can deduct all of this interest from your tax payment. It's as simple as that. And finally, this is probably the more practical way for most people. You head to a bank and you tell them that you want to borrow $500,000 to buy this amazing property. The bank will ask you for a down payment of 20%. You borrow the $400,000 at your $100,000 and you buy the property. Now, this property rents for X amount of money. You spend another $50,000 to renovate it, put some furniture, and boom, you can rent it 50% higher. The rent is not just going to cover the mortgage, but brings extra few dollars a month. For $150,000, you bought a property for $500,000, renovated it, and now it's worth like $700,000. That's how everyone makes money in the real estate. It is not some kind of rocket science. It's just the initial capital and the trust of the banks to give you that money. You get your first property, then the second, then the third. Once you have 3 successful mortgages behind your back that brings you cash every single month, you've built a successful business, my friend. At this point, banks won't hesitate to give you like millions of dollars. If you don't have that kind of money, then don't worry, because unlike real estate, you can start investing in the stock market with as little as $1. Donald Trump is a pretty good example of someone who used debt to build his multi-billion-dollar empire. Of course, some of his methods are quite controversial to say the least, but we're not going to look into that. If you make over $600,000, you probably pay over 37% in taxes, and that number could drop if the Democrats pass their tax bill. But as they say, the devil is in the details. If you would have made that $600,000 using that, you could have lowered your tax rate to 0% or even apply for a tax refund, as Jeff Bezos did with Amazon back in 2018, where Amazon received a federal tax refund of $129 million. If you master debt and real estate, you can use other people's money to make millions of dollars and pay absolutely no taxes at all. Consider this. Let's assume you're a hard-working man who saves as much as he can. After a few years of saving, you have $100,000 in your bank account and decide to invest in real estate. Of course, with $100,000, your options are limited. But here's how you can use debt to turn that $100,000 into a few million dollars in a matter of a few years. You find a property in a good neighborhood that costs $250,000, for example. You head to a bank and get a mortgage by making a 20% down payment. Now, you're left with a house that needs renovation, a mortgage, and $50,000 in your bank account. You spend another $25,000 to renovate the house, so your total investment jumps to $75,000. But the value of the house rises as well, let's say to $350,000, since you have renovated it and turned it from a place that no one wants to live into a place that people are willing to pay to live. You rent it out to cover your mortgage, insurance, and other expenses and make sure that it generates some cash flow. You head to your bank again, but this time refinance your mortgage. Since the value of the house is now $350,000, if you would get an 80% mortgage like you did the first time, you will receive $280,000. You spend $200,000 of that money to cover your first mortgage and you're left with an extra $80,000. You can use that money to get another mortgage, renovate it, rent it out, and create a second source of income. You can refinance your second house to get a third mortgage, and so on and so forth. And here's the best part. With just $75,000, now you control assets that worth millions of dollars, depends on how many properties you have bought, and created multiple streams of income. If you have done your research and bought into areas that are rising in demand, your properties will appreciate in value, which means you will be able to increase the rent. But your mortgage will gradually get smaller as the tenants keep paying them off. That's how most people get rich in real estate. And we did not even talk about all kind of deductions you get with real estate, starting from depreciation to deducting your mortgage from your rental income. Real estate isn't the only industry where you can use debt to make a fortune. Debt is used pretty much everywhere, including the stock market. Let's say you have $50,000 in your bank account and you're looking to trade some stocks. Based on your analysis, you believe that stock A will increase by 10% tomorrow. You can use your $50,000 to buy stock A. And let's assume that your predictions turn out to be correct. Stock A rises by 10%, you immediately sell your stocks for $55,000 and end up making $5,000 in profit. Great! But that's one way to do it. Your second option is margin investing. With a margin account, your broker would loan you an extra $50,000. So now you can buy stocks worth $100,000. If we use the exact same example and assume that you spend $100,000 buying stock A and sell it once it rises by 10%, you end up making $10,000 instead of $5,000. Suddenly, out of nothing, you doubled your income on the exact same deal. You don't have to make a lot of deals to build a fortune. If you're going to be right just once and leverage it, that's enough to make a fortune. That's probably the only shortcut to build wealth. But not everything is sunshine and rainbows. With leverage comes risk. A lot of risks. If the stock price falls below a certain value, your broker has the right to liquidate your stocks and leave you with a loss. so you have to be quite confident about your decision. For those who are not as risk tolerant as some of the other investors, there is an option to leverage ETFs. ETFs usually follow a particular index such as the S&P 500 or a certain industry or bonds. So instead of using debt to purchase a particular stock, you can try ETFs. Of course, ETFs don't usually rise as fast as individual stocks, but they neither fall dramatically since they perform as good or as bad as the industry average. But margin investing isn't as popular as short selling. You probably have heard about this term alongside Tesla, because these two words go hand in hand. While most beginner investors try to make money by predicting which stocks would rise in value, some professional investors make money by predicting which stocks would fall in value. It's not as confusing as it might seem. Stock prices jump up and down for one reason or another. Poor quarterly reports or any other negative news can drive the stock price down. Let's say Apple's stock price is $100, and tomorrow Apple is going to release its quarterly reports. And based on your analysis, it had a bad quarter, so the stock might fall. You borrow 1,000 Apple stocks from your broker and sell them for $100 each, or $100,000 in total. Now, you have $100,000 in your pocket, but you still owe your broker 1,000 Apple stocks. You use that $100,000 you earned yesterday and buy 1,000 Apple stocks for $80,000 since the stock price fell and return them back to your broker. Without using a single dime out of your money, you have earned $20,000 on a fall of a stock. Investors use this strategy all the time, especially with stocks that are more volatile, such as Tesla. That's why whenever you heard the news that Tesla stock has risen, there will always be an investor who will short it. Although on the last occasion, investors lost millions of dollars since Tesla stock kept rising. Short selling isn't just practiced in the stock market, it's much more popular in the foreign exchange market, or Forex in short. It works in the exact same way. However, in this case, instead of borrowing stocks, investors borrow currencies. The nature of currencies is that they fluctuate much more than stocks, especially due to geopolitical factors. The man who mastered Forex deals is George Soros. It's the 1990s. The British economy is suffering. Inflation is high, unemployment is rising, and the government is in chaos. Britain had to devalue its currency to survive, but it was part of the ERM, or the European Exchange Rate Mechanism, which fixed all European currencies against each other to prevent currency fluctuations to make it easier for businesses to trade across Europe. The demand for the British pound kept declining as Britain fell into a recession. Hence, the Bank of England had to buy billions of dollars worth of pounds to keep the pound at the same rate as other European currencies. While it was bad news for Brits, it was a billion-dollar opportunity for George Soros. By looking at the numbers, he realized that sooner or later the Bank of England would have to devalue the pound, even if that meant leaving the ERM. Soros was one step away from a gold mine. He went to various hedge funds, borrowed billions of pounds at a very low rate, and then sold them in the Forex market in exchange for German marks. The idea was simple. When the British pound will collapse, Soros will buy those pounds cheaper and return them, pocketing the difference. On September the 16th, when the president of the Bundesbank hinted in an interview that it is possible for some currencies to come under pressure, that night when Europe was asleep, Soros began calling all the major banks, or in fact, any bank, to borrow as many pounds as possible. By morning, Soros borrowed and sold over $10 billion worth of pounds. The Bank of England was in absolute disarray. The British pound was collapsing. The Bank of England purchased $27 billion worth of pounds, raised interest rates to 15%. But it was too late already. The entire market began to sell their pounds after Soros' move. Before the day ended, England left the ERM and devalued the pound, and Soros profited over $1 billion. Without spending a single penny out of his pocket, he borrowed billions of pounds, broke the Bank of England, and pocketed $1 billion. Can you really say that that is bad after that? It's 2005. Michael Burry is going through mortgage-backed securities and he's suspicious. Something unusual comes up. He can't believe his eyes, so he starts digging farther and farther. But the more he digs, the more he's shocked. Every mortgage-backed security is filled with multiple junk loans. In fact, these loans are given on the basis that the borrower doesn't have a deadline to pay the principal. They can even skip the interest on the interest, which meant that even a high school dropout with no job or savings could buy a house. Ideally, the rating agencies would give these loans a C rating, but investment banks pile them together with good loans and boom, now you have AAA loans. If a small minority of these borrowers will default on their loans, it will drag down the entire market. In 2007 alone, $500 billion worth of these loans were sold. That's when Michael Burry shorted mortgage-backed securities, exactly like Soros shorted the pound. He borrowed as many mortgage-backed securities as possible and immediately sold them in the open market, hoping that when the market will crash, he would be able to buy these securities at a much lower price and return them back. Everyone thought he was crazy betting against the housing market, but this
down 1.7% here, loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
Michael Burry walked away with a personal profit of $100 million. All of that was done with debt. But not everything is sunshine and rainbows. It's April 2020. Melvin Capital, Citadel, and a few other hedge funds decided to make a few $1 billion by bankrupting another barely surviving company called GameStop. By that time, the hedge funds had already shorted 140% of the total stocks. More shares were shorted than actual shares in circulation. It was a matter of time before the stock collapses, and hedge funds closed the deal with a few $1 billion for their investors. But something went wrong. A Reddit user realized that the only way these hedge funds can get out of this deal is by purchasing back all of the existing shares. If he purchases GameStop shares and holds them long enough, these hedge funds will pay whatever price you want to buy back the shares, because if they don't, they will keep paying interest since these shares have been borrowed. The Reddit post went viral and everyone began buying GameStop shares to the point where the stock price soared. Hedge funds purchased the stock at $5 to $10, but now had to buy them back at $300 or $400 to give them back. The news broke the internet. Wall Street was in absolute chaos. For the first time, retail investors beat Wall Street at their own game. At this point, the hedge funds knew that if they didn't stop this rebellion, they might go bankrupt. First, they pushed Robinhood to stop selling GameStop shares on their platform. Soon, other brokers followed. Even though they stopped the rebellion, hedge funds ended up losing almost $13 billion in the process. That is a powerful tool, but it's not for everyone. It can be your best friend or your worst enemy. Even if you have hundreds of millions of dollars stashed in your bank account, not a single smart businessman will use that money to grow the business. Instead, let the banks know that you and your companies, for example, actually have the money and borrow the same amount of money to finance your operations. At the end of the year, when it's time to pay taxes, you can claim that you did not make any profit on paper since you owe the bank so much money. Suddenly, instead of paying a 21% corporate tax, you pay nothing. And in case you need money to finance your lavish lifestyle, use the company's fund to pay for your private jet, expensive restaurants, and luxurious hotels, and write them off as a business expense at the end of the year. That's what almost every company does in the US or anywhere else in the world. In July of 2012, Mark Zuckerberg financed his $6 million Palo Alto home, that's 3 miles away from Facebook's headquarters, with a 30-year mortgage. At that time, he was 28 years old and the world's 40th wealthiest person. worth an estimated amount of $15.6 billion. The question is, why would you get into debt when you have billions of dollars and can easily afford it? If he wanted, he could easily buy a dozen $6 million homes in cash without batting an eye. So why get a mortgage? The answer is long and complicated, but in short, it's free money. Sounds ridiculous. Who would give you free money when you are already a billionaire? Let me explain. It all has to do with interest rates. The inflation rate in the US is 2.5 to 3%. So any money you borrow that's below the inflation rate is considered free money. Zuckerberg's mortgage rate is just a little over 1%, but it's adjustable, meaning that based on the circumstances, the rate could possibly go up for one reason or another. If you do the math, the bank is losing money since the mortgage rate is below the inflation. You don't have to be genius to do the math. For the sake of example, let's say you borrow $1 million at a rate of 1%. The average rate of return on the savings account is 2.4%, meaning that if you deposit that $1 million in another bank, you end up making $24,000 a year, while you only have to make a monthly payment of $10,500 to the bank that lent you that money. Imagine if you can do that with $100 million, or how about $1 billion? When you can borrow money for free, there is no point in tying up your own money when you can use that money for more profitable things. Of course, when you are talking about small amounts of money, this might not make sense because the difference isn't that big. However, when it comes to large sums, playing around with 1, 2, or even 0.5% could potentially mean dozens of thousands of dollars, if not hundreds. Let's say you are a businessman and you can easily afford $1 million house. Why buy a house when you can finance it for 1 or 2%, while you invest the rest of that money in your business that could potentially get you 10, 20, if not 30% returns? Even if you're lazy to find a more profitable way to use money, just throwing it all into an index fund can be much more profitable, especially when we are talking about 20 or 30 years. Historically, an index fund has shown to have an average rate of return of 8%. If you take a mortgage and invest your money in an index fund, the percentage difference will end up in your pocket. It all comes down to opportunity cost. Economically, it wouldn't make sense for Zuckerberg to buy the house in cash when he has been offered a 1% mortgage rate. But he is not the only one who is so smart to do that. Take Elon Musk, for example. Most of his wealth is tied to Tesla and SpaceX. To buy a house for $20 million, he probably might need to sell a considerable chunk of his wealth, pay taxes, and incur other expenses. However, he can take free money and keep his monthly payment under his budget. He took out a $61 million mortgage for 5 properties in California with a monthly payment of $180,000. That's not unique to billionaires, by the way. It's also practiced by moderately rich people like Jay-Z or Beyoncé. They took a mortgage to buy their $88 million house. They put 40% down payment and financed the other $52.8 million. That leaves the couple with $150,000 of monthly payments. In comparison, the national median home value is around $200,000. Instead of tying up $53 million in a house, he definitely knows where to invest it to maximize his profit. At the end of the day, he's made a lot of great investments and he's on his way to becoming a billionaire. The richer you get, the better ways you find to make more money. But let's be honest, not everyone gets such a low mortgage rate. Nationwide, it's around 3%. But even at that rate, it still doesn't make sense to purchase a house if you can finance it. However, wait a second, let's make this clear. Why do the super rich get a lower rate in the first place than the rest of the country? First of all, when you're a billionaire, the bank can sleep calmly because no one is worried that you might default on your loan, and in case if something happens, you can easily sell part of your business to pay back your mortgage. That takes out the risk out of the equation. Now compare that to an average employee who could get sick and not be able to work or just lose his job for one reason or another. Secondly, paying your mortgage on time every month helps you build and maintain a healthy credit score. So when you're in trouble next time, with a strong credit score, it will be much easier to borrow money from the banks. You're basically building trust between you and the financial institutions. But it also could be the other way around. Banks do offer such a low mortgage rate to establish a strong relationship with rich people so that when their companies would need a loan from a bank, they would come to them and not their competitors. It's a win-win situation. But these low mortgage rates are adjustable, which means, as I said earlier, they could go up. But no one is worried because if it stops making sense economically to these ultra-rich people, they can easily pay back their mortgage. But most people associate that with something negative because we usually borrow money that we can't afford for entertainments and end up paying a lot more back. In fact, right after getting out of college, you realize what a burden your student debt is already. And once you calculate how many years you have to pay back that debt, you immediately create a perception that debt is bad, especially when you can't even default on it. Playing around with debt is not easy. You are eventually taking a huge risk, and a small miscalculation can lead to disastrous consequences. In fact, we've got into so much debt that most people can't even afford an unexpected $500 bill because we have to make all of these monthly payments. However, that's what distinguishes bad debt from the good one. Debt can ruin your life, make you homeless, and cripple your family if you're reckless. But it also can make you unbelievably rich if you know how to use it, because it's leverage. Leverage is a superpower that can make you rich instantly. Let's say, for the sake of example, you buy this house for $10,000, go to the market and sell it for $11,000. Congrats, you just made a profit of $1,000. However, that's not much. But if you use leverage, you go to the bank first, borrow $990,000. With your additional $10,000, that's going to be $1 million. You head to your supplier and buy 100 phones now for $1 million. Turn around and sell it to the market for $1.1 million. But you still owe the bank, so you go back to the bank again and return them $990,000 that you borrowed earlier, and another $10,000 in interest. Now you're left with $100,000. After you deduct your own $10,000, you're left with $90,000 of pure profit. That's how you make money when you don't have money. The bank made their share of the profit and you made yours. Of course, when you take this formula to the extreme and it's not regulated by the governments and practiced by everyone in the Wall Street, it turns into a financial crisis, as it happened in 2008. Remember when home prices crashed and then they took down the entire economy with them? Well, it's because the investment banks used leverage to maximize their profit to the point where their strategy backfired. Because they began giving mortgages to people who didn't necessarily have the best credit score and weren't financially prepared to make the monthly payments. And then they defaulted on their mortgages, as they suppose. It was a nightmare for the investors, because for the last 40 years, home prices were rising and suddenly they are going down. Well, we're not going to get into the details of the 2008 financial crisis, that's a story for another video, but in any ways, it's a major tool of how rich people make money. Of course, it's risky and you can end up losing everything, but if you know what you're doing, you can make a fortune overnight. I hope you guys have enjoyed this video and most importantly, found it helpful. And if you did, make sure to give it a thumbs up, and if you want to see more of these videos, consider subscribing and clicking on the bell besides it, so that the next video will appear right in your homepage and you won't miss it. Thanks for watching, and until next time.